Good evening. This is the Elliott Wave update for the S&P 500 for Sunday, May 22nd, 2022. Very interesting Friday. We did see the S&P drop down, got close to dipping below 3,800, couldn't quite do it, found that to be support. The market then did a massive turn at the very end of the day, put in a strong rally, continuing to pick up the rally here in the Globex session. Now, what does this all mean? Is not a long-term bottom. That much I am fairly convinced of. And regardless of what the current conversation may include, the current punditry may include, this is not a turn in the market. So once again, I'm going to lay out the challenge. The challenge is, if this is indeed a turn in the market, what evidence do you have to show that inflation's under control, that interest rates have gone high enough, that bonds have bottomed in terms of price, that yields have topped in terms of price, in terms of yield, that the supply chain problem has been fixed, et cetera, et cetera, et cetera. Inflation, done. All these things have to be done? No, I don't see it. And I don't think it's anything more than right now, as I've got labeled, a minor fourth wave bounce. And once it's over, we will again turn lower. But in the meantime, we're going to have everybody screaming and yelling, oh, you had to get into the bottom, you had to hold your longs. Well, you're going to make some of that long money back, I'll tell you that. But unless you get out, you're going to end up chewing your left arm off, because maybe on the way down you chewed your right arm off because you've been in a trap and you believe in things that just aren't going to happen. There's no reason to over or reinflate the market at the moment. There just is no reason. People need to learn, when you buy something that is extremely overvalued, it will move back to the mean. It doesn't mean that Apple or Amazon or any of these top tech stocks are bad companies. They're not. They're well run. They have solid products, but overvaluation is overvaluation. And if you do your math, you're going to have to come up with what do they need to earn per quarter to maintain the price? If they can't do that, the price is not going to stay there. The markets will correct. We are in a repricing period where, if we take a look at interest rates, who I'm going to tell you sit at the top of the food chain, the top of the pecking order. What happens in interest rates affects everything. It's where you can, what rate you can borrow money at and what rate you can lend money at. So whether you're lending it out or whether you're taking or you're having to borrow it, interest rates are going to really put an impact on what you can and cannot do. Interest rates float down. We saw last week with retail earnings. That isn't just a one-off thing. That's overvaluation of a stock. Target had no business being above $200 a share. And then when they came out with that small loss, or with the loss that they had to show, because they need to reprice inflation into their models. And once that's done, then we'll get to fair value. Then we can start over. But the markets aren't even close to that yet. We went up for 2 years on an intermediate degree level. We went up for, I think it's 5 or 6 years on a primary degree level. We went up 13 years on a cycle degree. And on that super cycle wave 3 sitting way up here, we went up 80 years. That's what's being corrected. It is not going to be all over simply because we've dropped to 3,800 in the S&P. That's unrealistic. When you allow your positions to talk because you're desperate to get this market back higher so that you can start making money again, everybody else is an idiot, and you're the only one that's able to really do this correctly. And that's a sad story. Now, what is this? I believe is I've made an adjustment. Again, if you've been following me for a while, you know that I have interchangeably used the two counts. One where we were subdividing all the way down, one where the minor 1 and 2 were up here quick, And then we started to subdivide. Well, the market now has filled in its own blanks for me and figuring out that, yep, we probably have come down in a minor third. And what helps that is indeed the rally off of the lows and that push higher that we've gotten. Now, I'm just going to slip out to the weekly chart here in the S&P. We didn't get close. The weekly 200 in the S&P is sitting at 3682, so just below 3700. We only got down to 3802. Now, if we looked at the NASDAQ, then the NASDAQ came down and touched the weekly 200 a week and a half ago, or on the 9th of May, when we got to 11,689. Last Friday, it whipped and slid through 11,689, then dropped down to a low of 11,491, which broke that weekly 200. And it actually dropped an additional 200 points. But because it was extremely oversold, because someone put the call out, that's what we got to do, because people had their algorithms programmed to take advantage or to be triggered by that, and plus the fact that Apple had slid through 40, 39, 38, 37, 36, 35, 34, 33, 38 strike prices on the way down. It started the day wrapping itself around 140. It traded down to 132.50. It traded all the way through. That causes, and on expiration day, massive adjustments to be made. Gamma explosions left and right in the puts and the calls all around. If you were a trader in Apple, you were in living hell because you had to adjust and then adjust and then adjust and adjust. And it got to a point where you couldn't do it in the options, so you had to turn to the stock. Well, then in that last half hour, somebody got an idea. It's like, well, we need to get Apple back above 136. They managed to get it back above 137. So they pushed it $4 in 30 minutes. $4. That's a lot of adjusting, pushing all the way back up. So this isn't like, oh, we're all catching the bottom. It isn't like there was some major news that this is why we're going to go up. It had everything to do with expiration Friday. And that's pretty much in my mind about it. Now, pundits and everybody else are going to search for all these reasons. And the government's going to roll out the current administration's chief economic officer or whatever to say, well, yeah, recession's still a possibility, but hey, guys, take a look. We're doing better than the rest of the world. That's comforting. That tells me zip. So this overvaluation that we've pumped into it from this low, okay, so we're all done with that and now we should reinflate it? We can't. Cheap money doesn't exist right now. So Apple can't buy back its stock. Amazon, they're going to have a problem with their split. Stock buybacks are going to come to a screeching halt if they haven't already. Cheap money isn't out there anymore. And by the way, the interest rates, they topped in 1981. They bottomed in 2021. That's a huge decline. And if you think that 6 months into this covers that correction, that's your first mistake. Now, this is all in my humble opinion, but I don't feel that this is the right time. If you are bullish or bearish, you're going to get caught up in all this. I will not be bullish or bearish anymore. It's not worth it, folks. Trade the price action. I don't care if it's bullish or bearish. I hope it does both in copious amounts, just like it did on Friday. You had more opportunity to make more money on both sides, going down, and then when going up, that was the quickest $1,000, $2,000, $3,000, $4,000, $5,000 you could make in 30 minutes. It was awesome trading, awesome. And to stand aside or to spend time wondering why, or to go, holy crap, I'm short, what am I supposed to do? Or I'm long, do I need to add? Or wow, I'm back in the money. I don't have time. I just want to trade. Now, what could all of this be? Like I just said, I think it's a minor fourth wave. We have resistance coming back up, and let's look at the daily chart. In the daily chart, this massive rally has only just broken back above the daily 4 moving average, 4-period moving average. The 8 is at 39.64. I suspect that they're going to come up and at least tag it, if not outright break it. But outside of all this, we remain with the possibility that until the market breaks cleanly above 39.50, that's as high as it's going to get, and this thing turns around and it sinks like a stone. But I do feel that we will break 39.50. Once that occurs, then we're into that this is the ending point for the minor third, and we have a minor 4. And eventually we should do an A, B, C. Eventually we can get up to 4,100. That's the most common level on a Fibonacci basis, and I'm measuring out the third and then the retracements. We can certainly go above that, but I'm not looking for it at this stage. Again, nothing has changed for the reasons that the market was going down. We're just in a bounce. And if you follow what I've been talking about all along, we go in degrees. This is the minor degree. This is the intermediate degree. So when you get into the minute degree, fourth waves are going to be, that was pretty big, but now we're in a larger degree. So that fourth wave is going to be bigger. So each time it's done that, oh, we reached the bottom. Oh, we reached the bottom. Bam. Oh, we reached the bottom. Bam. We have not. Elliott is building blocks. We're in the process of an intermediate degree third wave down. It will consist of 5 waves of minor degree, of which now I'm saying we have 1, 2, and 3. Fourth wave is a rally. Fifth wave is a decline. That then completes the intermediate third wave. We have another fourth wave rally, and then another fifth wave decline on the intermediate degree. Then we can put in a primary degree, right? Going up, we can put in a primary A wave. The alternate count that I have, which suggests that this is still an intermediate degree, but an intermediate A, an intermediate B, and we're in intermediate C. Even if that's the case, we still have a minor 4 and a minor 5 to complete the intermediate C. So no matter what, we still have another leg down that will go below 38.02, and we'll measure it out in just a second. So I'm going to break this down to the daily, just so that we can discuss. It's very powerful. And when you look at it on this chart, it looks very powerful. The hourly chart, 1, 2, 3, 4, 5, 6, 7. We had 7 hours up. 7 green bars up. Time for a pullback. You won't hear anybody talking about it. Oh, we're bullish, we're bullish, we're bullish. But if we're going down, we're massively oversold. How about we're massively overbought? Doesn't exist. Okay, whatever you want to say. So don't get fooled by this. Trade it. Don't be bullish. Don't be bearish. Trade both. It's not the most difficult thing to do. In fact, when you have the volatility that we have lately, it comes in both sides. The volatility in a futures market produces faster moves. We go down fast, we go up fast. What we don't want is no volatility where the market just sits and you have to trade by appointment. So that will come eventually as well, folks. So please, I think if you're a trader, you need to be trading, not buy and hold, not sell and hold. You must be able to move in and out of the market. You take your profit, you bank it, you go to your next trade, you bank it, and you constantly are rolling. And if you're an options trader, you build positions and you work them and you get to your points and you're taking advantage of the options premium and you make your adjustments until you've reached your levels. Now, again, upside. If we break above 39.50, it should cement into place that we have reached that low for the minor third wave, and then we would be expecting the next move. And it's broken pretty cleanly on, at least in the hourly chart, and it's broke above the hourly 50. That opens the door that we should get up to the hourly 200 at 39.87, whether it does it tonight or whether it does it tomorrow or whether it does it at all. But that would be what I would be expecting as the next move. I would not expect the market just to keep going. We need to go, come back down, and rally again. It's an ABC. The most common point for a fourth wave is to rally or decline back towards the terminus of the fourth wave of one lesser degree. Well, I'm doing a minor fourth wave. I need to look at the minute fourth wave. That's right here. And guess what sits right above it? 382 fib resistance. It all lines up. So eventually, I'm looking for it to come back up into here, 4,100. That'll convince everybody downside's all done and we're just a glory, glory, glory. And then boom, we got another change. Maybe it happens before. I don't know. I wish the market paid closer attention to people's analysis, because then we wouldn't have to worry about this. We'd all be billionaires by now. So for tomorrow, I do consider that we should see continued upside. Downside, if this is indeed a fourth wave, should be limited. We should find stronger support at, come on, don't do that. Come on. This open there. We should find the support on a correction back down here at the 8 and the 20. The 4 is the only one that's really kind of moving, as it should. It's the shortest period, and it should just go right up with this rally. The 8's getting ready to cross the 20. That'll give more support to the rally. The 20 needs to get above the 50 if this rally has a shot at getting up here. These are all things that we need to see, that the market needs to see, that the buyers need to see. You're going to keep pushing the buy side, you better see these signals, or it's going to reverse in your face. Anyway, they're now all going to draw your attention to the fact, well, we got NVIDIA reporting, we got all these reports, we got Macy's, Zoom, blah, 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 still to come out. Retail is still reporting. I wouldn't be expecting anything different than what we have already seen. I wouldn't suspect or expect NVIDIA to outdo what we've seen in AMD, Intel, other chip makers. And it has nothing to say that NVIDIA or any of the other companies are bad or good. I feel we have a lot of solid companies in the tech sector. They're just overvalued, and it's time for correction. And when it's done, they will resume. Okay, so downside. If we start to go down with force and we break below these moving averages on the hourly, particularly the 20, and then we start coming down and we breaking price support down, and believe me, because of that huge rally, the price support, you might find some right around 38.75, 38.50, 38.25, 38.15, and then that low at 3,800-ish. Then we have additional support at 37.50, 37.15, and then it breaks below 3,700. And ultimately, if this holds here and turns and drops, then this isn't going to be put in place here. That's going to change the picture yet again. This is just trying to keep up But please remember, this is important. The market is fluid. If you can tell me, oh yeah, I was definitely expecting that rally to smack everybody down on Friday afternoon, I'd be like, oh wow, great. Share that knowledge with us. But so when you get into these situations, we get a lot of really like wild moves. So we need to be prepared and we need to be able to trade them. And this market can zip and go back down as quickly as it just zipped and went up, on the basis that nothing really for the long-term picture has changed. Nothing has changed. Zip. So I'm going to end it there. Pay attention to moving averages. Use them. They're our friends. They will help guide you in and out of the market. They help you trade. I tend to like using Heikin-Ashi bars on my short time frame charts, a 1 minute, a 2 minute. You could even go out to the 5 minute on it, because if you learn about the Heikin-Ashi and you know how to use them, they keep you in a trade. The Heikin-Ashi bars they'll show you, possible turn coming. But if you're not getting a signal, you stay in the trade. And on Friday, I used the Heikin-Ashi and I stayed in the trade, and it was glorious. Glorious on that last 30 minutes. You had no reason. And that's what I mean. I'm not bullish. I'm not bearish. I'm just going to trade what's in front of me. All right, everybody, have a really great trading day tomorrow. Next update will be Monday, the 23rd.